Alright, what's good everyone? It's Fear.ing. It's currently August 2nd, 2025, and we're here to make the final video, part 4 of 4, regarding my model. This video is on understanding draw on liquidity. So, being part 4 of this little mini series, you should have gone through the first 3 parts, which is the introduction, the checklist, and the narrative video. On top of that, assuming you have watched those, you already know you're instructed to watch the WAP videos and the 4 channels within the server that are labeled as this. So when it comes to what our draws on liquidity are going to be, it's going to be these. We have our significant highs and lows, hard time frame unmitigated imbalances, and EQ of unbalanced ranges. Obviously, assuming that you have watched all the WAP videos, you know exactly what the significant highs and lows are, and you understand that concept. You understand which highs and lows are significant, and most importantly, you understand why. Because price always trades from sequential SMT to sequential SMT. We don't just go from SMT to SMT. We don't just go from any random high or low to any random high or low. No. Price is always going to reverse and trade from a significant high or low, which are these. If price is going to reverse, we're going to have some sort of sequential SMT attached to that, which are going to be one of these. There's also our previous quarter's highs and low, which is our yearly cycle, and then of course our previous year high and low, which is our, I don't even know the name of that, so I'm not going to say it, but you understand that. Now, let's just say that there's no clear high or low that we can target. Then in that case, what we can also do is aim for a higher time frame unmitigated imbalance. Let's just say price is aggressively selling off. So we're going to reference the current market. And before we get into the example we're going to show. So let's just say price is aggressively selling off. And, we have price from, current market. As of now, there's no significant high low that we can really target, as, we're below the previous week low. We're below the previous day low on all 3 indices. The only thing we can target at this point is perhaps a higher time frame imbalance, such as this unmitigated weekly BISI, or perhaps we go up a time frame onto the monthly and identify, well, this unmitigated monthly imbalance, which also is perfectly in line with the previous month low. So a 2-in-1 higher time frame unmitigated imbalance, as well as our previous month low. That would be a reference to how we could use a higher time frame imbalance. Now, another draw on liquidity, and this isn't a reference in terms of prices immediately going to expand to it, but another draw on liquidity could be something like EQ of this given range here. Because as you can see, we are very clearly unbalanced, and what's likely going to happen is price is going to rebalance this range before continuing lower. Though at the same time, you could argue price is going to dip down, tap into that monthly/weekly BISI, and then continue higher, rebalance the range. Obviously, I'm just giving you a quick intro/example. Obviously, we're not expecting price to immediately rebalance it, but that's just a reference. So what would it look like? Well, in the most simple aspects, we'll just show an example. So here, let's just imagine higher time frame narrative is bullish. Price soups the previous 6-hour low on ES, we soup it on NQ, we fail to do so on YM right here. So we have daily cycle sequential SMT at the highs. And what do we see at the lows, my bad? YM fails to, NQ does, ES does. However, we look at the highs and you can see that there's no sequential SMT at the highs. So let's imagine that this is before this candle right here. Let's just imagine that the candle 3 is non-existent. We have yet to expand it within that candle 3. In that case, when price, forms a daily cycle sequential SMT, as you know, in the time frame alignment, we'd be looking for a 15-minute swing divergence. So we go from daily cycle to 15-minute down to a 1-minute time frame. So we have daily cycle sequential SMT, drop down to a 15-minute time frame. Look for, well, it should already be on the 15-minute time frame when identifying daily cycle, but I'm just giving a reference here. And if we form a 15-minute swing divergence, then we drop down to a 1-minute. Look for 1-minute CISD, and what we would do at that point is then target the daily cycle high right here. So what we'd be doing here is looking for an entry generally within here when that daily cycle sequential forms, and then looking to take a long position up to the daily cycle high. That is generally how draw on liquidity works in the most simple aspect. Obviously, we're going to show an example, but I just wanted to give a quick reference beforehand. So what would that example be? So we have a slideshow format. I'm going to just reference my trading view chart to make things simple. So this was earlier this year, and in the initial video that I made for John Liquidity, this was the reference I used. So I'm just going to do the exact same reference, even though I'd done that 2 months ago. I'm just going to repeat it. So going into this day, as we can see when we zoom out on a higher time frame, we can see that recent market structure has been bearish. We know that price ultimately ended up doing a smart money reversal here. However, recent market structure as of now is extremely bearish. In terms of a higher time frame PD raise, we can see that price is delivering from a weekly volume imbalance right here, as you can see on NQ. And then on the daily time frame, we can see that we are delivering from daily up close candles, as we can see right here. So in the sense of institutional order flow, short term, at least as of now, we are bearish. Obviously, what will confirm lower prices? Well, the whole reason we're looking for lower prices in the first place is one, because as of now, higher time frame market structure is bearish. Second, lower time frame narrative, we can see very clearly here that we have a unbalanced range below us because our previous day had aggressively expanded higher. Specifically, I'll quickly show the ruler to get a clear idea. We expanded 2,650 points. What does that mean? Well, regardless of how many points it is, when you just look at this price action right here, we immediately classify this as a unbalanced range, meaning even if price on the higher time frame is about to flip bullish, in order for us to expand higher at this point, this range below us has to be rebalanced. So going into this given trade, we are looking for rebalance below us, giving us a clear draw on liquidity. We zoom in. Actually, we'll go through the slideshow now. On the 1 hour time frame, what do? Well, unbalanced range below us, we soup the previous day high, aka a raid of the previous quarter's high, raid of the previous power 3's high, whatever you want to identify that as, forming weekly cycle sequential SMT. On the 1 hour time frame, to confirm the weekly cycle sequential SMT, we can see that we form a 1 hour PSP alongside a 1 hour open close divergence, confirming the weekly cycle sequential SMT. And from that point, we could be looking for a rebalance of the range below us. Now, you want to go back to this day, look for the trade I had taken. Well, it was April. Let's go forward a little bit. April 10th. So on this day specifically, how could you actually trade this according to my model specifically? Well, let's go right to market open, because as we know, my model wraps around that. So going into 9:30 open here, we'll quickly draw out EQ the range, extend that over here. We're looking to short down to EQ the range. All three indices are obviously nowhere close to it, so we still have a clear draw on liquidity going into market open. Our daily opened, we formed the weekly cycle sequential, which was also a daily cycle sequential at the same time. From there, overnight expanded lower. Directly going into New York open, as we can see right here, we can see that we formed 90-minute sequential directly going into New York open, as YM soups the Q1 90-minute high during Q2, while ES and NQ both failed to do so. From there, immediately giving us a lower time frame sequential SMT going into New York open. But how are we actually going to trade based off of that? Well, going into New York open, we can see that what do? Well, we form a microcycle sequential SMT right here, because as we can see, NQ during Q2, as we can see down here in this red box, runs the Q1 high, as we can see right here. Failed to do so on YM, we do so on ES, giving us microcycle sequential SMT going into New York open. Now, at this point, you have two options. You can either enter off the next 1 minute CISD, even though it's prior to market open, it's still a valid setup. However, it's a little bit high risk, as usually we want to wait until New York open before entering any sort of trade. Nonetheless, valid setup prior to New York open, and let's just imagine you did take that. Well, we're not going to reference that, but instead, let's imagine what we could do going into New York open. Well, going into New York open, what we do is, what what we do is form a 1-minute swing divergence inside of a 1-minute SMTF. And for reference, 930 was this up close candle right here. So we form a 1-minute swing divergence inside this 1-minute SMTF. It's an SMTF because YM and ES will fail to trade into the 927 CIBI while NQ does. Inside of there, we form a 1-minute swing divergence. From there, you can validate dropping down to a 15-second time frame, which it's actually not letting me. But let's just imagine hypothetically that it was somewhere right here. You enter there, stop loss at the high of the range, which has the microcycle sequential SMT supporting it. TP at EQ of the range. Obviously, you see a 91-point stop loss. You think that's crazy. No, it's not. Look your TP. Your TP is 750 points. Obviously, volatility during the market right now was absolutely insane. You can just imagine let's just imagine this is the current market. That would probably be a 30-point stop loss and maybe a 200-point TP. This would still be a perfect trade. All you have to do in this scenario is reduce your risk and enter with lighter size. That's all you have to do. So let's imagine hypothetically your entry was off of 15-second CISD. Imagining it was like roughly around there. It was all the way down here. I don't know. Well, let's just imagine it was generally around here. You enter off of that, stop loss at the high, and boom, you let price play out. Now, why are you looking to target EQ the range and not any sort of time-based low? Well, let's look really quick. Where is our time-based low? Well, in terms of intraday price action, all 3 indices at this point are already beneath our previous daily cycle low, as you can see right here. NQ, ES, and YM are all beneath it. And the only other time-based low aside from that would be the pre-sale low. But do we really think price is going to pump 2,600 points in one day and then immediately dump 2,600 points in the next? Probably not. It doesn't really make sense. What is logical would be half of that. EQ that range. That's the most logical thing you can assume. So you target EQ the ranges when there's no clear time-based high or low that you can target. And ultimately, price plays out perfectly from there. And how would you manage risk in a scenario like this? Well, as we understand, price moves from sequential SMT to sequential SMT. And at this point, the only reason we would have to go break even would be if price forms some sort of bullish sequential SMT. So if price ever did that after that point, we could move stops break even. But as you can see, we deliver completely. And that is overall how we can use draw on liquidity. Because at this point, we then be out of the position, and that's it. Now, I have a lot more examples in the server regarding my trade reviews. So go in my server, go watch my trade reviews, the videos, not just the chart reviews, but the actual videos, the losses, the wins. You want to understand how I trade, how I view the market, and what I look for TPs. This is just one example, again, to just give you an introduction to what I look for. But a lot of your learning will be from watching my trade reviews, every single one I post. And yeah, let me know if there's any questions. Otherwise, that is the 4 videos on my model.